I have two identical cups of coffee here. This is the highest, most premium, luxury coffee that you've ever had in your life. We're pretending. It's artisan stuff, really good stuff. And we're in some resorty kind of town, so the cup of coffee costs $20, right? So in order to have this once in a lifetime dream cup of coffee, it's going to cost you, this one is going to cost you $4 out of your pocket to drink this coffee, to get started on drinking this coffee. This one is going to cost you 70 cents. So which one sounds like a good deal so far? They both sound like good deals, right? $4, it's $20 cup of coffee, 70 cents. So for every drink you take, it only costs you 70 cents to get started on this one. But for every drink you take, it's going to cost you 1 penny. So you take a drink, so now it's 71 cents. Okay? Does that still make sense? So if you get down to, let's say you drink this much of the coffee, you drink 20% of the coffee, we're going to renegotiate with the restaurant to never have to pay again on that you know, the penny per drink thing anymore. We're not going to do that anymore. Okay? So both of them still sound like good deals, right? This one cost you 70 cents to get started. This one cost you $4 to get started. They're both $20. Nothing changed. Identical cup of coffee. So let's just say it would take you 300 drinks of coffee to add up to this $4, right? Because you started with 70 cents. This is $4 out of your pocket. This one's 70 cents out of your pocket. If you drink it 300 times, then you're going to be at the same price you were for this one. 300 pennies later, right? So, do both of them sound like a good deal? For your dream cup of coffee, you can drink this one for $4, which is still a heck of a deal. Or you can drink this one for 70 cents plus a penny per drink until you get to 80%. And then we renegotiate, and wherever you're at in that deal, you have to have at least 20% of it gone. You don't have to pay that penny cent charge anymore per drink. They both sound like good deals, right? This one could have cost you, let's say, it could have cost you $1.10. This one cost you $4, no matter what. This one could have cost you $1.10 because it took you ever how many drinks to get down to the 20%. Then you renegotiated and you didn't have to pay it anymore. Do they both sound like good deals? I'll let you decide. Well, what I just described to you precisely, I just changed some numbers. I took zeros off the numbers. What I just described to you precisely was private mortgage insurance. So this is conventional. You put 20% down, you have no private mortgage insurance. It costs you 40 grand on a $200,000 home. That's what I'm going off of. 20 bucks, $200,000 home. You put 40 grand down, which is $4. That's where I got the numbers. Okay, you have that cup of coffee. It's just a down payment. This one costs you 70 cents. FHA allows you to put 3.5% down. But the risk is higher for the lender, so they charge you an insurance. All it does is mitigates the risk and to get you into that dream cup of coffee. It mitigates the risk because maybe, I don't know, maybe your credit isn't perfect, or maybe you don't make $300,000 a year, whatever, doesn't matter. Let's just look at this as an FHA loan, and let's look at this as a conventional loan. So it seems to me that both of them are good deals. You can decide for yourself, but for some reason, real estate agents, probably uneducated, they've been educated or they haven't been educated, and they've kind of put out the word that you don't want to do FHA. You got private mortgage insurance. Oh, it costs a fortune. And even though it is more expensive because every drink costs you a penny, where this one, there is no, you paid your $4, you drink it until it's gone, until it you still owe $16 on the rest of the cup of coffee. This one costs you a penny every time you take a drink. You get it? So even though this one costs you a little more per drink per month, it's still worth it because you only have to drink down a 20%. You have to have a 20% equity, and then we can refinance you out of the private mortgage insurance if it's the worst thing in the world. But another thing to look at is it would take you to add up to this $4, the whole $4 that you put down, it would take you 300 payments to add, just to break even with the $4 you put down on this one. Does that make sense? So if it takes you $200,000 house, if it takes you 40 grand to put down, to have no private mortgage insurance, to save that penny per drink, you're out 40 grand. Got it? This one, you're out $7,000 to get into this dream cup of coffee. Does that make sense? So the difference between 40 grand and 7 grand is $33,000. It's going to take you 300 payments to break even. 300. That's like 20, what is that? 23, 24 years? Something like that? 25 years? That's a lot of years just to break even. So does an FHA loan with private mortgage insurance sound like the end of the world? You can decide. I just want to get you into your dream cup of coffee. All right, guys, that's it. That's all I got. If it makes sense, if you're a realtor and you've been told by a lender that FHA is somehow some crazy loan you don't want, it's too expensive, hey, get in touch with me. That's not the truth. Maybe they just don't work with FHA, so they don't know. Or maybe because conventional is so much easier to do as a mortgage loan officer, maybe they're lazy. I don't know what it is. But if you want a lender who doesn't give up on your clients just because they don't have perfect credit or a ton of money down, get in touch with me. Just message me and we'll make it happen. All right, guys, that's all I got. Later.